What if I told you that professional traders and everyday people are making money every single day by exploiting something most people never even notice? A gap between two prices for the exact same thing. No stock picks, no predictions, no gambling on which way the market moves. Just finding a price difference and pocketing it. That's arbitrage. And it's one of the most quietly powerful strategies in the financial world. Today we're breaking down exactly what arbitrage is, how it works, the different types that exist, and which ones are actually accessible to regular people like you and me. Some of these require capital. Some require time. Some require nothing more than a smartphone and a free afternoon. Let's get into it. At its core, arbitrage is the practice of buying something at one price and selling it at a higher price simultaneously, or close to it, in a different market, different place, or different form. The profit comes from the spread between those two prices. In a perfect world, markets would always be in sync. Everything would be priced correctly everywhere, all at once. But the real world is messy. Information moves slowly. Markets aren't always connected. Regulations vary. Supply and demand fluctuate. And those imperfections create gaps. Arbitrage is how you turn those gaps into money. The reason arbitrage is so attractive, at least in theory, is that it's supposed to be risk-free profit. You're not betting on whether a stock goes up or whether the economy is doing well. You're just exploiting a known price difference. Now, in practice, risk creeps in, and we'll talk about that, but the concept itself is clean and logical. Let's start with the most straightforward version: retail arbitrage. This is where everyday people are doing it right now at scale, on platforms like Amazon and eBay. The idea is simple. You go to a store, could be Walmart, Target, TJ Maxx, a dollar store, a garage sale, a thrift shop, and you buy products that are underpriced relative to what they're selling for online. Then you list them on Amazon or eBay, sell them at the higher price, and keep the difference. Sounds almost too simple. And in a lot of ways it is. But people are pulling in thousands of dollars a month doing this. There are Amazon FBA sellers, fulfilled by Amazon, who have turned retail arbitrage into a full business. They use apps to scan barcodes in stores and instantly see what that item sells for on Amazon, what the fees are, and what the potential profit margin is. If the numbers work, they buy it. If not, they move on. The challenge with retail arbitrage is that it's time-intensive. You're physically going to stores, scanning products, packing boxes, shipping inventory. Your capital is tied up in physical goods. And competition is real. If a deal is obvious, 100 other sellers might find it too, and prices on Amazon will adjust. It's a hustle, not passive income. But it's a legitimate way to arbitrage a real price gap between local retail and the online marketplace. Now let's talk about a version of arbitrage that exists in sports betting. And I want to be clear here, this is not about gambling. This is about math. It's called match betting or sports arbitrage betting. Different sports books, DraftKings, FanDuel, BetMGM, and others often set slightly different odds on the same game. And when those odds diverge enough, you can place bets on all possible outcomes across different books and mathematically guarantee a profit regardless of the result. For example, if one book has Team A winning at plus 115 and another book has Team B winning at plus 110, the math might work out so that betting a calculated amount on each side across both books gives you a guaranteed return no matter who wins. The arbitrage comes from the difference in how each sportsbook priced the event. This is legal and it works, but it comes with friction. Books don't like arbitrage bettors. They'll limit your account or ban you if they detect the pattern. You need accounts at multiple sportsbooks. You need capital spread across all of them to move fast when a window opens, because these opportunities close in minutes. It requires attention and speed. But the math works, and people do extract real profit from it. Crypto arbitrage is another version that got a lot of attention when crypto exchanges were more fragmented. The idea is that the same cryptocurrency might trade at slightly different prices on different exchanges at the same moment. You buy on the exchange where the price is lower and sell on the exchange where the price is higher. Instant profit. In the early days of crypto, these gaps could be substantial. A few percentage points on Bitcoin was not unusual. Today, with better market infrastructure and more sophisticated automated trading bots, those gaps are tiny and they close almost instantly. The players left doing crypto arbitrage at scale are algorithmic traders running automated systems that can execute in milliseconds. Manual crypto arbitrage is extremely difficult to profit from in the current environment. Not impossible, but the edge has been mostly arbed away, ironically enough. Now let's talk about one that doesn't involve trading at all: geographic arbitrage. This one is arguably the most powerful wealth-building application of the arbitrage concept for regular people, and it's completely overlooked. Geographic arbitrage is when you earn income in a high-paying market, like the United States, but you live in a place where your cost of living is dramatically lower. You're arbitraging the gap between your income and your expenses. A software developer earning $100,000 a year in US dollars, living in Chiang Mai, Thailand, or Medellin, Colombia, is living like royalty and saving 80% of their income. That's not lifestyle downsizing. That's a completely different quality of life, often better, on far less dollar-denominated spend. The spread between what they earn and what things cost in their local market is the arbitrage. This is real. Remote work made it mainstream, and if your income is location independent, this is one of the most asymmetric moves you can make financially. The same income that lets you scrape by in San Francisco lets you live extremely well in a lot of other places. Mergers and acquisitions arbitrage, sometimes called merger arb, is a strategy used by hedge funds and sophisticated investors. Here's how it works. When Company A announces it's going to acquire Company B at $20 per share, Company B's stock might immediately jump to, say, $19.80. Not all the way to $20, because there's still execution risk. What if the deal falls through? What if regulators block it? The 20-cent gap represents that uncertainty. Merger arb traders buy Company B at $19.80 and wait for the deal to close at $20, pocketing the spread. If dozens of deals are happening at once, and they're positioned in all of them, those small spreads add up. The risk is that deals do fall apart. Regulatory rejections, financing issues, changed economic conditions. And when they do, the stock can crater. So it's not truly risk-free, but it's a well-defined, bounded risk that professional traders have been exploiting for decades. Statistical arbitrage is a more complex version used by quantitative hedge funds. They're not looking at a single price gap. They're running models on thousands of securities at once, identifying pairs of stocks that historically move together and betting on the spread between them returning to normal when it diverges. Two airline stocks that usually track each other closely, for example. If one moves and the other doesn't, that's a potential statistical arbitrage trade. This is deep quantitative territory, but it's the same underlying idea. Find a price relationship that's out of line and bet on it correcting. Let's talk about the risks, because I want to be honest with you. The phrase risk-free arbitrage sounds almost too good to be true. And in practice, it usually is. Not because the concept is wrong, but because execution risk is real. Prices change before you complete both sides of a trade. Transaction costs eat into your margin. Books limit your accounts. Regulations change. Deals fall through. Technology fails. Competitors spot the same opportunity and close the gap before you can act. The cleaner the arbitrage opportunity looks, the faster it disappears. Markets are efficient enough that obvious large gaps don't last long. What's left, what's accessible, tends to be thin margins at high volume, or opportunities in less liquid, less connected markets. That's where the real edge lives. So what should you actually do with this? Here's the practical breakdown. If you want a ground-level entry point with real money-making potential, retail arbitrage on Amazon FBA is real and accessible. It requires hustle, some startup capital for inventory, and a willingness to learn the platform. But people build legitimate side incomes from it. If you have location-independent income or you're building toward it, geographic arbitrage is the highest leverage move on this list. Your lifestyle, your savings rate, and your wealth-building velocity all change dramatically when you widen the gap between what you earn and what you spend. If you're someone who follows sports and wants to treat it analytically rather than emotionally, match betting arbitrage is real. Just go in understanding that book limits are part of the game, and you'll need multiple accounts to make it work. The bigger lesson here is this. Arbitrage is a mindset. It's about looking for gaps, price gaps, knowledge gaps, geographic gaps. Arbitrage is what happens when you see that something is worth more in one place than another, and you position yourself in the middle. The most successful investors, traders, and entrepreneurs in the world are all arbitrageurs in some form. They're finding underpriced assets, underpriced opportunities, underpriced markets, and capturing the spread. Once you start seeing the world through this lens, you'll find gaps everywhere. If this video gave you a new way to look at money, hit like and subscribe to fuel your wealth. We cover strategies like this every week. Not the hype, not the get-rich-quick stuff, just the real mechanics of how money actually works. This is not financial advice. Always do your own research before putting money into any strategy.